everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree Asset Management. Well, certainly the last couple of weeks, we've gotten some news and some headlines that have created a lot of uncertainty in the markets. And the recent news of President Biden dropping out of the presidential race has no doubt created a whole new layer of uncertainty into the market backdrop. But interestingly, the spotlight is always on who's going to become president, but in reality, it's not that cut and dry. Indeed, equally important is what party is going to control the other two chambers of Congress. Unless we have Republican or Democrat in the executive and the legislative branch, it's really difficult to see what could get done, right? Unless they're all on the same page and they're all moving in the same direction from a policy standpoint. So with this much uncertainty hovering over the investment landscape, we recommend focusing on the issue which is arguably more clarity at this point, and that's Fed rate cuts. Now, this is the first of a series of Money in Motion podcasts, blogs that I want to do to discuss how investors should be looking to play rate cuts in their fixed income portfolio. While getting to this first rate cut has not been a smooth ride, and we're not even officially there yet, it does appear that Powell and company are getting more confident in such an easing move occurring at the September FOMC meeting. Remember, we do have a meeting next week, but not expecting anything there in terms of actual policy decision. So what this rate cut cycle is going to ultimately look like is also an important consideration. At this point, the Fed seems to be gravitating towards a policy that remains restrictive, but not as restrictive from what is currently in place. So in other words, inflation has made enough progress towards their 2% goal, so why not take the foot off the brake pedal a bit? And whether or not this potential easing cycle takes on more momentum will highly depend on the labor market setting. So if the unemployment rate holds steady to, say, just modestly higher, then arguably rate cuts will not be that aggressive. Conversely, a visible weakening in labor market conditions combined with continued disinflation will no doubt lead to a more active rate cutting policy. So how does an investor prepare for these possible monetary policy scenarios? Well, the time-tested barbell strategy. By utilizing this approach, investors are afforded flexibility to begin adding duration in a deliberate fashion while still taking advantage of the income available with less volatility in the ultra-short portion of the inverted yield curve. Yes, the still inverted yield curve. And the Wisdom Tree in-house barbell uses our floating rate treasury fund, ticker USFR, for the ultra-short position, and our yield-enhanced U.S. aggregate bond fund, ticker AGGY, AGGY, for the duration counterweight. Now, I recently blogged about that still inverted treasury yield curve and how the 3-month 10-year differential remains well into negative territory to the tune of over 110 basis points as I'm talking to you today. Now, with treasury floating rate notes being referenced to the 3-month weekly T-bill auction, one could take advantage of what this negative yield curve will more than likely continue to offer even when rate cuts begin. The adding duration aspect is designed to not only begin locking in yield outside of shorter dated maturities, but also offers the ability to try and take part in a bond market rally if rates were to reverse course, say, and fall again. Now, for investors who would prefer more of what you would call, say, a pure rate play and not have credit in it and focus only on U.S. government securities in their barbell, we would recommend considering a solution from our Treasury suite of funds, and that's the Wisdom Tree 7 to 10-year ladder Treasury fund, ticker USIN. Now, this fund would represent that adding duration aspect to the barbell I just mentioned and serve as the tool to lock in yield while potentially benefiting from a decline in rates further out in the yield curve. So with uncertainty surrounding the investment landscape and Fed policy becoming front and center in the discussion as summer progresses here, the barbell approach provides investors with a time-tested, flexible strategy to navigate this road ahead without making an outright rate call. So I'm going to end it there. Hope everybody's having a great summer and have a great rest of the week, everybody. Be well. And before investing, carefully consider a fund's investment objectives, risks, charges, and expenses contained in the prospectus available at wisdomtree.com/investments. Read it carefully.